Hello, I'm Pat O'Hare, Chief Market Analyst for Briefing.com. Today is Wednesday, October 15th. So far, from what we can gather, there have not been any new government initiatives announced today as part of a plan to stabilize the financial system. That in itself is news, as it is a step toward returning to a seemingly more normal market environment where earnings news and economic data carry the day as opposed to government plans. In that vein, the main happenings so far today haven't set the most optimistic tone. The good news is that leading companies like Intel, Coca-Cola, and JP Morgan Chase all reported better than expected third quarter earnings. The bad news is that each cast some doubt on the near-term outlook. Intel, for its part, cut its capital expenditures budget and said business levels are difficult to predict. Coca-Cola anticipates the operating environment, especially in North America, will continue to be challenging. JP Morgan, meanwhile, increased credit reserves by $1.3 billion and warned that it is reasonable to expect reduced earnings for the company over the next few quarters due to the uncertainty in the capital markets, housing sector, and economy overall. Separately, Wells Fargo, Abbott Labs, and State Street also exceeded consensus estimates. Concerns about the economic outlook, though, are reflected in the negative disposition of the market, with the major indices starting lower despite the batch of upside earnings surprises for the third quarter. Falling oil prices reflect the economic concerns as well. Crude futures are currently down 3.7% to $75.74 per barrel, marking a near 50% decline from the high they hit in July. The drop in oil prices have been constructive in terms of inflation pressures, and the September Producer Price Index suggests as much. Led by a 2.9% decline in the index for energy goods, producer prices fell 0.4% in September. That was in line with expectations. Year over year, producer prices are up 8.7%, which is an improvement from the prior reading of up 9.6%. Core producer prices, which exclude food and energy, were up 0.4% versus the consensus estimate that called for a gain of 0.2%. Core producer prices are up 3.8% year over year versus 3.6% in August. Inflation levels remain elevated. However, the presumption now is that weakening demand should lead to a moderation in inflation pressures in coming months. Declines in the price indexes for crude and intermediate goods the last 2 months helps validate that view. This consideration will help offset the disappointment linked to the higher than expected headline print for core PPI. In turn, there is a presumption that consumer spending will be curtailed by the drop in asset values, the jump in the unemployment rate, and poor confidence readings. The September retail sales report did not do anything to alter that thinking. September retail sales fell a sharp 1.2%. Economists had expected a decline of just 0.7%. Excluding autos, the decline was 0.6%. Again, that was higher than the expected decline of 0.2%. The drops were not a result of weaker gasoline sales either, as that component rose fractionally. These data are not hard to analyze. They are poor from an economic standpoint. They won't alter third quarter GDP forecast much, which will still get a strong boost from the trade data and inventories, but they do take the consumer spending trend lower heading into the fourth quarter numbers. On a final note, the New York Empire State Index, which is a regional manufacturing survey, fell to minus 24.6 from a prior reading of minus 7.4. A number below zero reflects a contraction in business activity. These reports should ensure that the Fed's Beige Book report on economic conditions, which will be released later today, will be anticlimactic. In the interim, the market will turn its attention to a speech on the economic outlook from Fed Chairman Bernanke at 12:15 p.m. Eastern Time. I'm Pat O'Hare for Briefing.com. Thanks for listening.